Here's the number one question I get from S Corp owners. I'm paying myself a salary, so how do I get the rest of my money out? Let me show you. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no tax using my zero tax blueprint. One of the biggest misconceptions I hear from people who have a single member LLC taxed as an S corporation goes something like this. Wait, if I have to pay myself a salary, does that mean the rest of my money is just stuck in the business? The answer is no. And today, I want to clear this up completely because once you understand how the salary and distribution actually work together, the whole structure starts to make a lot more sense and feel a lot less intimidating. Now, here's the mindset I want you to have going into this. When you have a single member LLC taxed as an S Corp, think of yourself as wearing two hats. One hat is the business owner, the shareholder. The other hat is the employee. Same person, two different roles. As the employee, you receive a W-2 salary for the work you perform. As the owner, you receive distributions from the profits the business generates. You earned all of it. The salary didn't take money away from you. It's just one of the two doors through which your money comes back to you. The distribution is the other door. And the reason this structure exists is that those two doors are taxed differently. Understanding that difference is where the value of the S Corp election lives. Your salary is your W-2 compensation as an employee of your own business. The business processes it through payroll, withholds taxes, and pays you whatever schedule you set up, weekly, biweekly, twice a month, whatever works for you. Now, the IRS does require that this salary be reasonable for the work you're performing. That's intentionally vague and on purpose because it depends entirely on your industry, your role, and what your business actually does. There is no universal number. What matters is that you're not paying yourself a token salary just to avoid taxes while doing all the real work of running the business. But here's the key thing I want you to take away. Paying yourself a salary does not lock up the rest of your money. It's still sitting in your business account, and you have every right to access it, just through a different mechanism. That mechanism is the distribution. A distribution is how you, as the owner, access the profits of the business above and beyond your salary. Once your S Corp has generated a profit and you've paid yourself a reasonable salary, the remaining profit can be distributed to you as the sole shareholder. Here's why that matters from a tax standpoint. Your salary is subject to payroll taxes, Social Security and Medicare. Your distribution is not. It flows through to your personal tax return as pass-through income. You pay ordinary income tax on it, but that additional payroll tax layer isn't there. In practical terms, you earned $180,000 in your business this year. You paid yourself $75,000 salary. The remaining $105,000 is profit sitting in the business account. You can transfer that $105,000 to your personal account as a distribution. It's your money. You earned it. You're just accessing it through the owner door instead of the employee door. Now, and this is important, you don't have to wait until the end of the year to take distributions. Many S Corp owners take them quarterly or even monthly alongside their estimated tax payments. The timing is flexible. What matters is that distributions are documented as intentional owner draws, not just random transfers back and forth between accounts. There is one concept you need to understand when it comes to distributions, and that's basis. Your stock basis in the S Corp is essentially your running financial stake of the business. What you've put in, what profits have passed through to you, minus what you've already taken out. Think of it as a running scorecard of your investment in the company. In this example, when you started the business, you contributed $50,000 in capital. Now your stock basis is $50,000. Then in year one, you had an $80,000 profit, increasing your basis to $130,000. You follow that with a distribution of $60,000, which leaves a basis of $70,000. Now, going into year two, you have a $95,000 profit with a $70,000 distribution, which leaves your basis at $95,000. Year three, you have a $30,000 profit, but take a distribution of $55,000. Now your basis is $70,000. But then in year four, you had a $40,000 profit and you took a $120,000 distribution, leaving you with a negative basis. The reason basis matters is this: you can only take distributions up to your basis without tax consequences. If you take a distribution that exceeds your basis, that excess doesn't just pass through clean. It's treated as a capital gain and taxed accordingly. For most single member LLC owners operating a profitable business, basis isn't usually an issue, especially if you're taking distributions that are reasonably in line with the profit flowing through. But it is something that is tracked on your K1 each year, and it's worth understanding so there are no surprises. The takeaway: basis is a guardrail, not a wall. Run your business profitably, keep your books clean, and it generally takes care of itself. Now, one thing that trips a lot of single member LLC owners up, especially when they're new to the S Corp structure, is treating the business bank account like a personal account, pulling money whenever they need it, paying personal expenses from the business, never really distinguishing between salary and distribution. The whole point of the two-door structure is that each door is documented and intentional. Your salary runs through payroll. Your distributions are logged as owner draws. Your business account and your personal account stay separate. This isn't just about keeping the IRS happy, although it does that too. It's about protecting the liability shield your LLC gives you. Courts have stripped away LLC protection from business owners who couldn't demonstrate that the business and the person were actually separate. Clean books, clean transfers, and clean documentation. That's how you keep both doors working in your favor. So let's bring this home. Your salary and your distribution are not competing with each other. They are two parts of the same system working together. The salary compensates you as an employee. The distribution returns profits to you as the owner. You earn both. You have access to both. The structure just determines how each piece flows to you and how it's taxed. The S Corp election on your single member LLC doesn't lock your money up. When it's set up and run correctly, it actually puts more of your money in your hands, because a portion of what you earn comes through a door that doesn't have payroll taxes attached to it. If you've been confused about this, or if you've been hesitant to take distributions because you weren't sure you were allowed to, hopefully this clears that up. Talk to a CPA who works specifically with small business owners and S Corps, because the details of your salary and your basis are worth getting right. If this was helpful to you, subscribe to the channel and like the video, and check out our prior videos on NB structure and S Corps. We'll see you next time.